Good afternoon, ladies and gentlemen. I'd like to call this meeting of the Cuyahoga County Investment Advisory Committee meeting to order. Can we please call the roll?
Katie Gallagher.
Here.
Brad Cromus.
Present.
Dale Miller.
Here.
Everyone's accounted for.
Okay, thank you very much. We have a quorum, and with that, are there any public comments submitted prior to the meeting?
There's one public comment. It's Mark Ashhead.
All right, please state your name for the record, and then you'll have several minutes to speak. There's a clock that you'll be able to see. So,
Thank you. Mark Ashhead. I just wanted to raise to everybody's attention something that was included in the state budget that is relevant to this advisory committee. There's a amendment to a current bill which prohibits any of the following, which includes the investing authority of a county, treasurer of state, from making an investment decision with the primary purpose of influencing environmental, social, personal, or ideological policy, unless expressly authored by Ohio law. Furthermore, if any of the persons or entities above delegate the management of the investment of public money to a third party, the bill prohibits the people from permitting the third party to make investment decisions with state money with that same intention. In addition, the bill prohibits State Department Board of Deposit from ordering the Treasurer of State to sell or liquidate investments or deposits with the primary purpose of influencing any environmental, social, personal, or ideological policy unless expressly authorized by Ohio law. So I just wanted to raise the awareness because as we've seen over the last year and a half, there's been a concerted effort to direct county investment policy, not based on financial considerations, but rather political ones. The push to divest, the push to not reinvest dollars based on political or ideological reasons, something that many of us throughout Cuyahoga County have not agreed with. And as such, the investments in question are amongst the best performing investments, most stable investments with a consistent return and without missing a payment. As I'm sure you know, Israel's had a tumultuous history in its 78 years, never missed a payment on these bonds. And so I wanted to raise this because I do think it's an important consideration as we look forward to our investment policy, as we look forward to future maturations of these bonds. How we're handling it is a very important piece moving forward. Understand that the county's investment health still is not at the point where these bonds can be reinvested, but we are hopeful that once that status is recognized, that these investments will be reinstated. Thank you.
thank you, Mr. Ashhead. Any other public comments submitted prior to the meeting?
No.
All right, with none on the docket, we'll move into the agenda itself. Everyone should have received copies of the minutes from our prior meeting of April 24th prior to the meeting. I would entertain a motion to accept those minutes.
Move to approve.
Second.
Moved and seconded. Any discussion on the minutes, corrections, changes, et cetera? Seeing none, all in favor, please signify by saying aye.
Aye.
Aye. No opposition or abstentions, so the motion passes. Next item on our agenda is a fund and portfolio review. We will invite first our team from the Treasurer's Office to share some local perspective on various topics, and then we will turn the floor over to our friends from Meter Investment. So with that, I would invite Jed and Eileen to share the county's presentation.
Thank you. Do you want to bring up the presentation, please? Okay. Keep going. Two more pages. Next one. There you go, right there. Okay, this is a snapshot of our accounts at the end of the second quarter. And if you look at the top part, the general funds, our Star Ohio accounts are increasing. We don't touch the ARPA funds. Star Maine, it's actually, that's where we float all of our real property tax collections. So it is on the rise. However, it's the holding account for when we make out payments to all the taxing districts. So it will decrease again. And Key Bank, PNC, US Bank, those are our primary operating accounts that we use on a daily basis. Below that is the investments that Jason Zabo is here from Meter in person to talk about. But if we go to the next slide, the next two slides I'm going to have Jed talk about.
Okay, so you might recall from the last meeting, we started creating a cash flow projection for the rest of the year due to the cash crunch that we had at Q4 and then start of Q1 of this year, Q4 of 24, and then this Q1 of this year. So we created this cash flow projection to kind of present you know, in the interest of full transparency, see where we were at. The cash flow that we have in current balances there in Star Ohio, $138 million. This is again as of the end of Q2. Since we're in the middle of collections, this number has gone up pretty dramatically over the last couple of weeks because we are collecting real estate taxes. But as of the end of the quarter, that's where we're at with liquid assets. US Bank Pivot, that's a combination of coupon payments and maturing bonds. The anticipated revenues that we'll be getting, at the time of the end of the quarter, we're looking about $110 million for the county's portion of real estate, because we only keep the 10% of the real estate bill for operating purposes. Looking about $11 million in interest. And then bond maturities through the end of Q3, because that was going to be our look forward and say, okay, where are we at? What can we do as far as continuing to reinvest funds? We want to make sure we don't have to sell bonds before the maturity. So that's, again, why we're trying to create this cash flow analysis to begin with, but also that point in time at which we'll have bonds maturing. And then our permissive sales and use taxes, that's going to fluctuate, but we've been pretty resilient as far as those dollars coming in due to the suspension of the tariffs that were announced in Q1. We were expecting maybe some hit, but they were, for the most part, suspended. So we're able to really not see an impact on our permissive sales and use tax. So that's a big part of why we're looking better with our year-end projections. And then, of course, you see other expenses that we expect. The payroll, real estate assessment has not changed from last quarter, but that's still a potential outflow that we have to be concerned with. And the remaining debt service wires for the rest of the year. And then you see the projected balance that we expect to see about $224 million. So again, we want to wait until after settlement of real estate taxes so we can make sure that our liquidity is something we can look at investing. Next slide, please.
So, can I ask a question? The $224 million, that's as of when?
That's a projected balance for the end of the year.
End of the year,
So
okay.
That's projected. That's not something we have on hand, but we're hoping that's where we end up so we can get back to investing money, locking in interest rates for longer.
And the $30 million for real estate assessment, can you say a little bit more about what that is?
Yep, that essentially, we get money from the state to fund the real estate assessment project that we have to do every 6 years, I believe. And any money we don't spend on tasks related to that has to go back.
I see, okay. Okay, thank you.
Any other questions? No? Next slide, please. Oh, we already have it up. Perfect. Now, since last quarter was the first time we did this analysis, we have some questions around, how was our projections change from the last time we did it? And this is the slide referencing that. A lot of it's self-explanatory, but I'll run through each line item. Star Ohio has gone down in balance because we were ramping up 2 collections through much of the second quarter. So that balance went down as we spent down for operating purposes and the like. The U.S. Bank pivot, that sweep account I mentioned, that's gone up because we have not been reinvesting funds. We've been, as bonds mature, we allow them to, to sit in the sweep. And they're still earning interest there, but it's not locked in long-term interest rates. So that's where we'd like to be. We'd like to lock in these high interest rates. But right now, with cash flow uncertainty, we're erring on the side of caution, or hopefully not erring at all. But if we're erring, we want to make sure it's on the safe side of things. Anticipated revenues, we see decreases in those revenues. Much of it's because we've received those revenues. So we've received more real estate taxes, even though we weren't in full collections. Some people pay a month early. Some people on early payment plans and the like. So some of the real estate taxes were collected, some interest was received. So those anticipated revenues went down from the last quarter because they became actually received money instead of anticipated money. Same thing with progressive sales and use tax. I mentioned bond maturities. And then going forward, looking forward to spend, I'm still employed, other people still employed, we're still gonna get that payroll money. So the county's gonna be spending that out to keep people employed. We have seen payroll decreases because we've been trying to cut back on replacement, not layoffs, but not replacing people who retire or leave for other reasons. And so we have seen a slight decrease in our payroll since Q1. And that's due to that approach. And then debt services, as I mentioned, that's gone down a bit because we paid off some of the debt. So, and then we see the projected balance has increased over the last years due to permissive sales and use tax and due to us expecting lower payroll throughout the rest of the year. Any questions about the change in our cash projections?
So it was 167 million, the last projection.
The last projection would have been 167 less our current projection of 224. So it was around 60 million or so that we were projecting as of the end of last quarter. But we have a positive variance due to payroll being, getting smaller as, we reduce replacement. And also because permissive sales and use tax, we were expecting tariffs to impact that more. And since most of the tariffs were pulled back, we didn't see much of an impact on the demand side. Jason may talk more about those kind of macroeconomic viewpoints. But other things could have happened is people, retailers bought a bunch of things before tariffs hit. And so a lot of the prices weren't impacted by the tariffs, even though, so there are a couple sides to the equation for why we're seeing a favorable variance in permissive sales and use.
So the prior projected balance was 167 and the current one is 224.
The current one's 224.
So that's a difference of 50 some million.
Right. Let me speak to a little slower. I talk fast sometimes. The current projected end of year balance is 224 million.
Right.
The change from Q1 was 167. So we've improved the projection of having 167 more in cash than we projected at the end of Q1.
Right.
So Q1's expected was about 60 million. It's improved by 167 million, and we have the projected total being almost $250 million.
And of that 167 million improvement, how much of that is accounted for by moving things from investment to cash, which doesn't change our total assets, but it improves our cash position?
Correct.
As opposed to either increasing our revenues or reducing our expenditures, which actually improves our...
Improves our full standing. Yeah,
Right.
That's a very good question. The answer is, you see up here on the total balances, the 17 million, that's the total improvement and our liquid cash. And that is simply the spend down from Star Ohio, about 15 million. And US Bank Pivot, that's an additional 32 million or so in bonds that matured, plus coupon payments, that have added to the balance that we have in that cash category. So in other words, that 32 million increase in US Bank Pivot, those are changing from fixed rate instruments, bonds, commercial paper and such, into our sweep account. So that's just reclassifying it from a fixed investment held to maturity into a sweep vehicle.
So how much is there in actual revenue improvement or expenditure reduction?
The improvement in the estimate is about 150 million improvement.
A lot,
It's a lot.
yeah.
Yep.
Well, it's important to note too that those are volatile figures, right? So we won't know definitively really where we're at until the end of the collection. And once settlement is complete, we'll have a little bit better picture that should be a little more stable for the rest of the year.
Right.
So that's kind of the inflection point to circle on your calendar is the end of settlement.
So that'll be when we know what the exact settlement amount is. And the next slide identifies a lot of the uncertainty around these numbers. Because these are numbers that we've said, here's what we think is going to happen. But the crystal ball was broken this week, and we weren't able to say definitively. So there's a lot of things that create a cloud of uncertainty around all of this. Just as we did with Q1, the tariffs are the big what's going to happen question. We didn't see a lot of impact because for the reasons I've mentioned, but we're back in that same cycle of big tariffs on everybody. So how does that happen? How does that go through? How does it impact our permissive sales and use taxes? Again, we don't know, but that's out there as an uncertainty. The budget is a known quantity, but the pace of that spend down is unknown. And so that can impact the interest that we earned. Delinquency rates, we're looking pretty good as far as our last projections, but we're still not done with collections. So that is a less uncertainty that we had at Q1, but still some uncertainty there. Again, with payroll, we've seen a positive variance from difference between Q1 and Q2, but that's still an unknown. The RA spending did not increase quarter to quarter, but it could. So again, uncertainty. And then again, it assumes from a cash flow perspective that debt service wires will not be expedited. They were last year. If that happens again, that can create or aggravate a cash crunch.
I mean, I would say that REA, we do fully expect to see a spend because of the obligation of the fiscal officer to return the money this year. In addition to that, overall spend, because the 860 contract that goes before council, a large portion of the number of employees in the 860 contract are funded through REA. So the annual amount for REA will actually go up as well, the spend down.
Do we have any ballpark numbers about where that might end up? Is
I
30
don't,
million?
we do, but I don't know it off the top of my head. I can get it to you.
Okay, yeah, appreciate that.
One more thing to talk about the REA, we are anticipating another $10 million coming in. That is not accounted for because that's not in quarter 2, that's in quarter 3. So we will get more funding for that. The other thing, Dale, you brought up about the, where the Star Ohio and where we are. One thing to note that you guys can't see on the paper, on July 15th, we had our first advance, which was $250 million. And so that was funds that were part of this $138 million that was in Star. So that we had acquired more real property taxes and we already paid out one advance. And so even though the money looks big and there's 225 million projected, we're still at the same point. We're paying out money and we have another settlement that's probably going to be about $800 million in August. So that's why we can't give a true picture until anything after collection. Okay?
And just for the good of the order, on the point of the cash flow projection, we have had 2 quarterly meetings now between our office, the budget office, Public Works, and a bunch of others to make sure that we're all kind of aware of upcoming expenditures. So we are keeping a close eye on that, and I think that's been a valuable process for us in terms of making sure that we have early awareness of those things as we look to begin reinvesting again toward the end of the year. So I just want to make sure that I note that for everybody that those conversations are ongoing and I think are valuable.
More questions, or? What's the next slide then, please?
Oh, yeah.
This is the breakdown of our opioid portfolio. Again, we see the increasing amount in the money market accounts, so that's the sweep there. Again, we don't have a certain direction. I know there's a plan that's being finalized, but we don't have it finalized. So we're not sure how the spend down is going to be structured. As a result, we're kind of letting bonds mature and creating that liquid cash flow until we get further direction from the opioid team. Next slide, please. And this is the graph that shows the Star Ohio rate. So as you would see, it's tapered down to there the last few quarters. And as of last night, at midnight, it was 4.46%. So again, we're still earning good interest in the sweep accounts, the Star Ohio accounts, but these are not locked in for a long time. As you can see, the average date of maturity is about 30 days. So we like to lock in the higher rates, but can't do so until we're sure about the cash position.
All right, thank you both very much. Any questions for Jed or Rebecca? Jed or Rebecca, who's over there? Or Eileen, who's sitting next to me. Good, very good. Well, if there aren't any then, that's a good point. And I was actually thinking of names because we have a third Jason with us today. Jason Headings and Jason Click are both otherwise occupied, but we have the privilege of Jason Sabo, who I understand is the brains behind the operation anyway at Meter. So if you're ready and willing, sir, the floor is yours to present on general market conditions in our portfolio.
Excellent, thank you. I don't think I'll take, well, since the other Jasons aren't here, I suppose, yes, you have the better Jason of the three today. So as Brad mentioned, we'll spend the time today going through a capital, is it just the green dot? Oh, it's good? Yeah, so go through the capital markets update, then review both portfolios and look at a comparison of the yields across the operating fund in addition to some other different comparable investments. So starting, I think the first slide, walking through a really high-level view of the key metrics that are impacting the short-duration fixed income markets. And naturally, the first and foremost and most important is Federal Reserve policy. And as we stand here today, the FOMC has continuously, for this entire year so far, is expressed a forecast of further reduction in the policy rate by 2 quarter points in reduction by the end of 2025. And importantly, this also encompasses their expectation on inflation rising over the summer months due to the tariffs, as were previously mentioned. In addition to the labor markets continuing to loosen, they're still expecting that there will be sufficient rationale for them to further reduce the policy rate. On the inflation front, looking at the consumer price index, it has continued to remain above 2%, with the current rate at 2.4% on a year-over-year basis. Additionally, economists, as along with the Federal Reserve, are expecting, as a function of the tariffs over the summer months, to perhaps see pressure on the inflation rate continue to rise a bit on the short term, but ultimately seen as those price level increases as a one-time event. On the growth front, we saw in the first quarter, GDP growth came in at a negative 0.5%, and that was largely a function of businesses and consumers recognizing the tariff announcements, really getting ahead in terms of goods and services ordering, that ultimately, from an accounting perspective, brought the aggregate GDP figure to a negative number. You see the imports actually surged at a substantial number from a record 41% from over a quarter, as again, folks were really demonstrating through that statistic alone that people were really trying to get ahead of any price increases associated with tariffs and any uncertainty that the tariff announcements could arise from a supply chain management perspective. Importantly, from that quarter, we saw a significant difference in this large increase in imports that has not carried through into the second quarter. So we're largely expecting GDP for the next quarter to be positive. But I think importantly, there's other metrics to look at that can give insight to the underlying trend of the U.S. economy. And those are pointing to broadly that the trend growth rate in the U.S. economy is certainly slower than it was in 2022 and 2023. And lastly, from the employment mandate and really on the economics front is the labor market. So we can think about the labor market being relatively balanced with a teetering on looser labor market in one of more concerns as opposed to going in the other direction of strength. The unemployment rate is been around 4 to 4.3%. But importantly, there's other signs of loosening, whether that's the hiring rate has certainly come down over the last 6 months to 12 months. Unemployment claims have been on the rise, jobless claims have been on the rise, so really speaking to the balance of the labor market tilting to more loosening. Then lastly is, I think everybody might have expected with the announcement of tariffs over this quarter, we've seen two-year Treasury yields and broader market interest rates certainly decline rapidly on the heels of the announcements and the re-announcements, some of the alterations to the policy. But since then, we've certainly seen a rebound in market interest rates, whether looking at the 2-year or 5-year part of the Treasury market, there's been a rebound in interest rates as policy has become what's characterized as a little bit more on pause. There's been different times when the tariffs were supposed to be implemented. There's been negotiations, extensions, so the market has certainly rebounded from the initial decline in interest rates. If we go to the next slide and taking a deeper dive into a number of these key factors and really highlight a couple, I think, really important points. And this chart here is looking at the federal funds futures rate, which is a way for the market to price in their expectations where they view the Fed policy rate is going to be at the end of December 2025, which is the orange line, and then the teal line is where the market is expecting the federal funds rate to be at the end of 2026. I think two things are really important on this side is, one, both at the end of 2025, the market is very much aligned that despite some potential elevation from inflation as related to tariffs, that the Fed is going to continue to embark on normalizing their policy rate lower. And additionally, I think the other piece, as you look at the teal line in 2026, is despite the timing is very uncertain to when they'll do the next cut, whether that's September or December, or maybe it'll leak into early March, is once the tariff portion of inflation abates, the market is really expecting, along with the Fed's projections, that policy normalization is going to continue throughout 2026, and the market's currently expecting the federal funds rate to get down to that 3% area. And last piece, I think, of critical aspect to highlight is there's a lot of, obviously, release of data, anxiety or nervousness around tariffs. The Federal Reserve is also taking those in considerations as they put together their forecast. So they're expecting inflation to be higher throughout the course of this year. They're expecting their inflation by the year end to be around 3%. So despite that forecast of higher inflation, they believe the price level changes, if they do come to fruition, and that's the big unknown, is whether or not you'll see ultimately inflation increase substantially over this next summer months, that even if it does, it's going to be a one-time price level change and not something that will be persistent like we experienced in 2022 that led the Fed to raise rates and keep the policy rate on hold for a substantial amount of time. So they're going to look through that and ultimately continue to normalize policy rates. On the next slide is, let's focus a little bit more on inflation. So this chart and table is looking at personal consumption expenditure index and the core measure, and this is the measure that the Fed uses for guiding and really managing how they think is the right way to view inflation. And importantly, as you look at the left-hand side, the teal line is looking at the year-over-year numbers of core inflation. And yeah, it was certainly elevated at 5.5% going back to 2022, but there's been a continuous trend of the year-over-year rate getting lower and lower, not yet to that 2% target, but certainly there's been enough progress. And here most recently, as you look at this orange line, which is looking at the 3-month annualized rates of the recent releases, and since 2024, you've seen the 3-month annualized rates at 1.7%. So where we stand today is going this last 6 months, and certainly particularly this last 3 when tariff announcements have happened, and there's different times when goods get brought in and when prices actually get paid, but certainly to this point, we have not seen a significant influence on tariffs as it relates to the inflation environment. So it's been a very positive outcome on the inflation side that's helping with the mandate and this idea that the Fed will further ease policy in 2025. Next slide is the employment mandate. Again, there's a lot of different avenues for which we can evaluate the strength and overall health of the labor market. I think the best way to characterize the labor market, as I mentioned earlier, is it's in balance with an eye towards weakening and loosening. I think we can see from a non-farm payroll perspective, which is the report that shows the change in payrolls month to month, that average number of payroll growth in 2025 has come down to about 123,000 per month, which is far different than what we experienced last year when the average monthly payroll increase was averaging about 163,000 jobs per month. So we're having net job growth is much lower so far this year. Additionally, and this is a really long chart, both of them looking at the weekly jobless claims, looking at a 4-week average, and the bottom half is looking at continuous jobless claims. And both of these measurements are looking at when individuals do lose their job, they have the opportunity to file for jobless claims. That gives the market a way and to assess if there's a lot of people losing their jobs and filing for claims. That's certainly a sign that the labor market is certainly not in a great balance. Additionally, continuous jobless claims, that measure takes after you initially file for your jobless claims. Folks who are not able to obtain a new job quickly are able to provide or able to get continuous insurance benefits. And importantly, I think as you see in the top head and the teal side, focusing here in 2024, it's really still at historical lows. So I think when you think about the labor market, companies and industries are generally of the stance that the hiring rate is lower, but they're also not shedding their workforce either. So there's been a lot of research suggesting perhaps the scars of the tight labor markets that everybody remembers when it was very difficult to find people that had a skills match to what you're needing, and the compensation you had to pay for the labor was actually really high. There's fear of shedding some of the workforce and then perhaps having to bring them back on later is really a strong hurdle for people to lay folks generally off in a mass amount. However, you can see on the bottom orange chart, being the continuous claims, is that even though when people do happen to lose their jobs, and then importantly to get a sense of the balance, is this continuous claims data has continuously slowly risen throughout 2024 and then here in 2025, suggesting that yes, layoffs may be low, but when people are being laid off, your ability to get and obtain a new job is becoming really challenging, that there's not a lot of demand from businesses to hire people. That's a bit of a concern from our vantage point, and it has the Federal Reserve also concerned, again, that the labor market can continue to loosen, and if we do see layoffs, we might see the unemployment rate tick up quite rapidly.
Yeah, and Jason, just to further explain the chart, so the gray bars there are recessions, yes?
Yes.
So, and the rising kind of indicator on the chart has preceded recessions historically. So
Yes.
another thing I'm sure that we're keeping an eye on, right?
Correct, yes. So generally, there's a sign, as you can see, as you're alluding to, the gray bars being recession. It's important too, this also is a good way in parallel to think a bit about Federal Reserve and historically why they sometimes are behind the curve in terms of reducing interest rates or raising interest rates. The employment market is one of their mandates to ensure their full employment. There's a tendency, as you look at taking the orange line, you start to see it rise, but when it rises rapidly, we're already in the midst of a recession. So that's when, if you look at some of these data points, it's important to look at early signs of the loosening, and the FOMC is certainly paying close attention. But as you see these figures increase rapidly, it's certainly a cause of concern that we need to be thinking differently about Fed policy rate and about how we're managing the portfolio and risk around it. Now, lastly, from an outright yield perspective, is mentioning on the onset, so this chart is looking at the 2-year Treasury and the 5-year Treasury rates going back to 2004. And then looking at the right-hand side, as we mentioned, really we've seen this decline in interest rates over the last couple months as it relates to the uncertainty around tariffs and what that could mean for the Federal Reserve policy rate. But importantly is they still are in a greater context, why we're bringing this to the table, and we think it's really important as it relates back to the overall strategy side, is yes, despite some decline in market interest rates here recently, in a longer time horizon, interest rates are significantly elevated than from a historical context perspective. So there's a ton of value from where, despite the interest rates coming down, locking them in today relative to history is a great benefit for budgetary certainty, income generation, and despite some of the pressure that we've seen from rates coming lower, it's still a great time to lock in interest rates out into to the 5-year part of the Treasury market and within the overall portfolio. Now, before we go into the portfolio, I'll pause. There's a lot there. I'm sure everybody has other headlines and things that are perhaps on their mind. Happy to pause and handle any questions that relates to just to the economic side. Perfect. Hearing none, and we'll go right into a review of the core portfolio. So as previously mentioned, top left-hand side is looking at how much is in cash being what's within the custodial sweep vehicle at US Bank, that being that 44.6 million. Securities portfolio is at 765 million with a total portfolio size of that 810 million. The weighted average portfolio maturity is still sitting at that just over 2 years, so a good representation of purchases and investment decisions made in the past to lengthen the portfolio, to lock in interest rates previously. That has kept, despite being in a uncertain cash position, the weighted average yield of the portfolio has continued to increase, being at that 3.38%, ultimately leading to an estimated annual income number of just shy of 26 million that's coming off the portfolio itself. From an asset allocation perspective, continuously maintaining a high bias toward strong credit quality with the combination of U.S. Treasury securities and U.S. agency securities being government-related. Those combination of those two instruments are adding up to about 78% of the overall portfolio. So again, with a lot of the uncertainty, making sure that risk management is strongly embedded in the overall portfolio, with just nearly 80% within government-related securities. On the weighted average or the maturity distribution, really what we're trying to target from an investment perspective, where applicable and where we can, is continuously, as I mentioned, is looking in to lock in interest rates out that 4 to 5 year part of the portfolio, 3 to 4 year part of the portfolio to provide that budget certainty and take advantage of these elevated interest rates, knowing that the policy rate is largely expected to decline, not just in 2025, but as we look beyond 2025 into 2026, the expectations are for the Fed policy rate to further come down. So given the opportunity to lock in interest rates for a longer period of time.
Yeah, and Jason, I know we didn't put the dot plot in the chart this time in terms of the upcoming FOMC meeting, but the expectation is not that there will be a reduction at the next meeting. It would be the subsequent one,
Yeah,
correct?
so currently we're, for a period of time during the last quarter, there was a chance that the Fed will cut rates in July. That has quickly shifted after the last non-farm payroll report to the market eyeing September as the next time that they'll cut interest rates.
And just to put a finial on that, that's important for us from the perspective of our cash flow conversation and when we're going to start reinvesting or look to reinvest. So I just want to contextualize that a little bit. Thanks.
Thank you. Then next, from an annual investment statistics perspective, looking at a table of over time how the portfolio has changed from a size perspective, from a maturity profile perspective, and then ultimately from an overall yield, how that's changed over time. Naturally, as we talked about, given some of the cash flow scenarios, the portfolio is at that $765 million size. The weighted average maturity has obviously gone lower as a function of rolling maturing securities into cash and not reinvesting them all back into the portfolio. That would keep the weighted average maturity longer. But importantly, with those lower yielding securities that were bought in a different interest rate environment have matured, the weighted average yield and the earnings of the portfolio have continued to come up from quarter to quarter, and expect that to continue to happen as time goes on.
Just a quick request on this. Can we add the annual interest income
Yep.
and projected annual interest income to this chart? Because I think that's helpful context also. Thanks.
Yep. The next slide is a table comparing our current portfolio allocations across different security types relative to the investment policy limits. And you can see here from a test results perspective, each one of the rows in the corresponding column at the far right indicating the test results are showing a green check mark next to each one, indicating that the portfolio is in compliance with the investment policy as it relates to these various security types. So nothing to report on that front. Next slide is going back to that quarterly comparison where we're looking at the top table is the current weighted average maturity, the yield of the portfolio at 3.38, the 0 to 5 year U.S. Treasury index, a representation of a index that if you made no asset allocation decisions, no duration adjustments, this is what the yield of that portfolio would look like, being at 2.91%. So where from a portfolio strategy perspective, we utilize other asset classes beyond U.S. Treasuries. We make decisions on lengthening and shortening the portfolio based on expectations of interest rates. That difference between those two numbers, being at 47 basis points, indicates just from a change in strategy over time, change in asset allocation over time has led to increased earnings from the overall portfolio as opposed to just sitting in a portfolio that's purely held U.S. Treasuries and didn't manage the duration over the different interest rate and cycles. So a good positive outcome from utilizing these different investment vehicles and changing the strategy over a course of time. Last one on there, naturally, Star Ohio, as previously mentioned, is at that 4.48% level. Now, looking at the bottom chart and time series is taking how the portfolio looked like just today and going back over a longer time series, recognizing that, yes, different interest rate environments, when Fed policy is moving higher or lower, you'll see the dramatic effect of that as it's to that Star Ohio dark blue line where it'll rise rapidly, but also when they're declining interest rates, that yield will also decline quite rapidly as well. However, the portfolio for Cuyahoga County being the green line has maintained its relative performance relative to that benchmark over a consistent time period and has relatively strong spread relationship to that index. Any questions on this slide? Going to the opioid settlement portfolio, very similar, right, as talked about previously. The cash portion is at that $8.4 million level. Securities is at $55 million, not quite 56 million. Total portfolio size being at $64 million. Portfolio maturity profile of the portfolio is very similar at 2.13%. The yield is slightly higher than the other portfolio, just on a minimal basis. And that's really directly a function of a couple different things: timing of reinvestments into different interest rate environments, and the timing of when the overall program started. We were in a different interest rate environment is the main function. But a very similar story too. Over time, as reinvestments occur, you'll still see the earnings potential increase within the settlement account as well. Currently, they're estimating a projected annual income at this portfolio size at that yield level is just over $2 million per year. And lastly is another review of the compliance front from the investment policy, looking at the current allocation of the portfolio in terms of various security types relative to what's maximum allowed from the policy perspective. And happy to see the test results column going down each row. They're all check boxes green, indicating that the portfolio is compliant with the overall investment program.
Okay, great. Thank you, Jason. Any last questions for Jason on the portfolio or the report? Okay, hearing none. Go ahead, I'm sorry, Dale.
So I have a question that might be for both Meter and for us. The question is when our next committee meeting is scheduled for, and if there will be a recommendation as to whether we're ready to resume investing in longer-term securities prior to that time.
Yeah, I appreciate, I can speak to some of that. Do you have the date? Yeah, Eileen's looking that up, but while she looks up the date of our next meeting, which will be in September, I believe, right? October. We are planning, once settlement is finished, to circle back with Meter and make a game plan for that at that point, because again, that's the point at which we'll have a little more certainty as to what our cash flow looks like, and then we'll be able to make some decisions at that point for the committee to review in October. And then the date is?
Tuesday, October 14th,
There we go, thank you.
2:30.
And would we possibly resume reinvestment prior to the next meeting, or would we not do that until it's been discussed in this committee?
That is a to-be-determined question at this point. I wish I had more for you on that, Councilman, but I just don't have that crystal ball at this point. So we'll have to circle back on that again, probably in early September is when we'll start talking about that, so.
Okay, thank you.
Okay. If there's nothing else, then I'd entertain a motion to accept the investment portfolio as presented.
Move to accept.
I second.
All right, moved and seconded. If there's no discussion, all in favor, please signify by saying aye.
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 No abstentions or objections, so the motion carries. Next items on the agenda, just some quick updates for the good of the order with respect to link deposits. We've continued to have conversations about the Heritage Home and help programs, proposals to bring in some small business components with local banks. Those conversations are ongoing. It has been an interesting series of conversations, and I think the tenor of them at this point is whether or not that is the correct tool to do community reinvestment, or if there are other tools that the banks could use themselves that we as the county could leverage. So they have been good conversations, but we are not yet at a place where we're able to present any kind of substantive change to those programs. So for the time being, they're status quo ante until we hear otherwise from our banking partners and our partners who administer those programs. So
And are those programs in operation under status quo conditions?
that's the current situation, yes, until such point as they are not, they are in operation, so they remain available for folks to take advantage of for the time being. Yep. And then under other business, just again to reiterate for everyone's information, we have had a request for proposals in the field for investment advisory services. In the intervening period between meetings, we had responses from 3 firms and are in the process of finalizing an offer to our successful bidder. So we'll have more to share on that in October, but I think that's all I'm allowed to say about that at this point, so we'll leave it there on that point unless anyone has questions or concerns about process.
Yes. Are we allowed to say who the 3 bidders were?
I believe we can do that. Yeah, our bidders were the incumbent meter. We also got a proposal from US Bank and from our PFM, I believe is the acronym, right? At PFM, and they do some work with bond counsel for us on various things, so those are the 3 firms.
Okay, thank you.
Yeah, thank you. And then just last item of business on the scheduled agenda, just to share for everybody's information. We recently applied to the Association of Public Treasurers of the United States and Canada to have their organization do an independent review of our investment policy as passed in January. That is an entity that previously did that work for us in 2015, but that's the last time we had them take a look, which is probably the last time there was a substantive rewrite of the investment policy. So that organization is exactly what it sounds like. It's a group of public finance officials from across the United States and Canada. They have a set of best practices that they review policies against. And as a result of that, we received a letter from them on May 30th congratulating us on the effort we undertook to rewrite that policy and providing us with a certificate of excellence, which is a great achievement. I want to thank my staff and Meter for helping us to craft that. We feel very proud of the work that we did on that, as well as this committee for taking a look at that and seriously considering some of the changes that we made. So we are in a good position. The best practice they recommend is doing a review every 5 years. As part of our state statutory mandate, we're going to be reviewing the policy again at the end of this year and bringing proposals forward in January for the committee to consider again. They provided us with a list of several changes that they suggested we consider making, and we have some others that we've kind of thought of after reviewing with various parties within the county. So continuous improvement is kind of what we're after in that area, but something that we can celebrate today, and folks are invited to stick around. We're going to have our communications team come up and take a picture, which they're coming in now, so perfect timing for that once we're done here, just to celebrate the fact that we made that achievement happen. So just wanted to share that with you all. I think that's a good thing to celebrate at the end of the meeting. So having said that, is there any other business for the committee to review or entertain at this point? Okay, seeing none, may I please have a motion to adjourn?
So moved.
Okay,
Second.
moved and seconded, and without objection, we are adjourned at 3:20. And as previously mentioned, our next meeting will be October 14th at 2:30 p.m. Thank you very much.